Good morning, everyone, and welcome to the May 2nd Joint New York Power Authority and Canal Board meeting. This time from sunny and balmy Messina, New York. We're all here, at least for the first time in my tenure at the St. Lawrence Visitor Center. Excited to do so. It's a home game for Judge Nicandri, a rare home game.
Yes.
So I'm not sure how many we've had in your 8 or 9 years on this board, but we're all pleased and excited to be here. A very special day, dedicating and officially opening the new Nature Center and honoring the judge, and we're incredibly proud and enthused to do so and look forward to that later this afternoon. But with that said, we still have official business to transact. So if I can, I will formally welcome my fellow trustees who made the trip collectively here. Trustee Pacente is participating via video. We've got others in Albany as well, back in White Plains. Gil and a good number of his executive team has joined us here on site. So with all of that, I'll officially and formally call this meeting to order. First item of business, as always, is to adopt our proposed meeting agenda. Had a slight amendment to open the meeting in a brief executive session. So we will do that. But if I could, I'd ask for a motion to adopt the agenda as amended to include the opening and executive session.
So moved.
Second.
Second. All right. All in favor? Aye. Aye. Any opposed? Motion carried. With that, I have a motion to move to executive session.
Yes, Mr. Chairman, I move that the Authority and Canal Board conduct an executive session pursuant to Public Officers Law, Section 105F, to discuss the financial, credit, or employment history of a particular person.
So moved. Do I have a second?
Second.
Second. Thanks very much, Ann. Any questions? Otherwise, all in favor? Aye. Aye.
Aye.
Any opposed? Motion carried. We'll briefly adjourn into executive session and be back in public session shortly. Thanks very much. Welcome back, everyone. Appreciate your patience and sticking with us. If I could have a motion to reconvene our meeting in public session.
So moved. Second.
All right, motion seconded. All in favor? Aye.
Aye.
Aye. Motion carried. All right, first up on the agenda, approve the contractor's requests. We've all been polled, as we typically are prior to the meeting, regarding conflicts. They've been duly noted. Karen and team are aware of all of that. If I could, any other changes, any late-breaking conflicts that anyone's discovered or identified? All right. Otherwise, have a motion to so approve.
So moved.
Second.
Second.
Any questions, comments? Otherwise, all in favor? Aye.
Aye.
All right. Motion carried. We have a extensive consent agenda. Most of our materials, frankly, ran to consent agenda items, many of which are in the ordinary course. One item of note, Gil, was for procurement services, IT co-sourcing.
Yes.
Can you or your team give us a couple minutes of clarity relative to what's a significant multi-year but nonetheless significant award?
So this is a multi-year RFP to retain strategic consulting services for IT over the next 5 years, and I'll ask our Chief Information Officer, Ken Lee, to give the board a little background about this item. Ken?
Thank you, Gil and board. So this is a request for approval to move forward with a contract vehicle for approximately $15 million per year across 5 years, totaling $75 million. This is not an authorization to spend, but rather a contract vehicle for us to leverage for a strategic relationship with vendors that understand how we do business, and as a result of understanding how we do business, can work more efficiently in getting our needs taken care of. Additionally, it was a vehicle that was competitively bid, allows us to achieve significant pricing advantages over what we have today. Well, I guess any questions that you have?
I had a question, Ken. It looked like a significant number, 25 in the memo, of the 39 responses were judged unresponsive due to lack of completeness. Do you want to talk a little bit about that?
Yeah, so we worked with procurement following all of our procurement rules. We had a significant variance in the number of responses. We had some of the people that filled out some of the sections, didn't fill out other ones. We had other ones that withdrew their RFP. We had one that was put in pricing, but we couldn't figure out what the pricing was because they didn't follow the format. So there were a lot of reasons of why they were excluded. We feel like we came up with some really good vendors that we definitely support and have followed all of our procurement policies in achieving that result.
So the 3 selected vendors then came from the remaining 14 responses, which you felt left a pretty deep pool?
They did. We actually met with them as well, and we feel very, very positive that we came up with a very, very competitively bid set of vendors, as well as vendors that have the quality to help us achieve our strategic initiatives.
Is that kind of hit rate typical, Ken? I don't know, maybe it's you're the wrong person to ask, but do you typically find a broad-based response to RFPs, 2/3 of which aren't qualified or don't complete the request properly? Is that typical, atypical in your arena or others? Because I agree with Ann, it's a pretty high kick-out rate. So are people just throwing it against the wall and hoping something sticks? You're a more rigid, disciplined approach. Anybody respond to that? Or is there a way we can improve process to ensure we're that much better in defining expectations, wants, and needs, even from our own internal efforts, to not have to spend undue time kicking 2/3 of the applicants out?
So, Mr. Chairman,
Anyone?
I can respond to that. When we were trying to do the RFP for the energy commodity risk management system, we didn't have as many vendors responding, but we had 8 vendors responded, and out of that, 4 did not complete the process as required. So that's a pretty high rate when people, I think it goes back to your point that people may just be responding to see what sticks.
Okay.
So, but it
Or
doesn't.
anything we can look at our own process.
It doesn't preclude us from, as you mentioned, better managing expectations by being more accurate and more precise with the way we present the solicitations, and we will certainly look into that.
Yeah, manage perceptions as the level playing field and all the rest of that. So, okay, great.
Thank you.
Any other questions relative to items and matters included in the consent agenda? Otherwise, I ask for a motion to so approve.
So moved.
So moved.
I have a motion, a second. Tony, thank you. Any other questions, comments? Otherwise, all in favor, aye. Aye.
Aye.
Except the items I'm
Yep,
excluding.
understood.
And mine as well.
Understood. Any votes in the negative? All right, consent agenda so carried. All right, we now have customary reports. Gil, strategically, Sabaglia Risk, and then the operating team, including the financial report, before Keith wraps us up with the compliance program and recharge.
I'll go up the podium.
Okay.
It'll be a very quick presentation. Good morning.
I just want it
Mr.
really
Chair.
good. It can be quick
Yeah.
as long as it's really good.
It will be.
Okay.
Good morning, Mr. Chairman, trustees, management, and the public. There you go. Is it up? So back in 2013, we created what we're calling NYPA 2020 strategic plan. And like any other strategic plan, it requires constant review and adjustments. We recently had an offsite a couple of weeks ago to relook at our plan, scan the horizon, assess what has changed. And as you can see on the left side of my chart, there are changes both in state policy, or more emphasis on state policy, sustained low gas prices that impacts the wholesale electricity markets, and increase in competition even in the provision of customer solution services. So those are things that we need to take into account. We talked about that during our offsite a few weeks back, and we have another one, in fact, coming up, Bob, May 11th, to finalize that. And our goal eventually is in about a month or two, we will resubmit to you our tweaks and our improvements to that strategic plan, new sets of deliverables between now and 2020, and so that we can align all of our resources and inspire all of our staff to execute and implement and realize the end goal of NYPA 2020. Next slide, please. As I mentioned, we had an offsite. A few themes came up, aside from doing the competitive analysis and the scan on where we are and some scenario planning on where things are going to be, not just what's around the corner, but over the horizon for NYPA. One area that's getting very, very clear to us is digitization is a major cross-cutting theme in our strategic plan. We are in the process of making NYPA the first digital utility, probably not only in the United States, but in the world. We are implementing digital technologies from end to end. We are digitizing our power plants, substation, and transmission system by building digital replicas of power plants, digital replicas of transmission system and substations, for the purpose of being able to do data analytics and be better informed in managing our assets, guiding our investments, both capital and O&M, and also optimizing their operations as we integrate more renewable energy sources such as wind and solar, and push forth the goal of Governor Cuomo, which is to have 50% of our electricity come from renewable energy by 2030. On the customer side, the same thing. We built New York Energy Manager. We are now monitoring about 3,400 buildings, 1,400 real-time. We're creating digital replicas or digital twins of public buildings across the state. And the goal there also is to help optimize the energy use of those buildings so that we can create very efficient buildings in New York State with flexible demand, so that when there are grid constraints or changes in the grids, buildings actually can respond to those changes. So that's the world we're in, the Internet of Things, digital technology, high-speed computing power, better power electronics, better material science advances, not only in our industry but in adjacent industries, are really propelling the evolution of the electric utility industry, and we intend to be a leader in that area. And we are a leader, and we are going to be in this area. Very, very exciting. Staff's very excited, and we're raring to go and raring to move forward.
So there's a May 11th session, and then what?
May 11th. After that, in about a month, we want to finish our the tweaks that we need on our NYPA 2020, both in terms of what is the end in mind, as well as what are the very specific deliverables that we need to do between now and 2020 to get there.
And so we'll see something as a board when?
The next,
In July?
yes, in
For
July.
Okay.
meeting?
And so you manage expectations here, but you're calling them tweaks, so there's no hard right or hard left here?
Yeah, but
This-
we are confident that the end
Path
in
we were on
mind,
is
exactly,
still-
and the end in mind that we selected back in 2012, 2013 when we put this plan together is still pretty much the
Still relevant?
very relevant, that this power grid that is a one-way flow, big power plants, transmission, distribution to customer is changing to become more of an integrated grid, multi-flow system where
Right.
distributed energy resources will now have to interact
Right.
with the classical large power grid. That vision is still intact. What's changed is an acceleration of the state's goal to get renewable energy into the electric mix, 50% by 2030. That is a mandate that now will have to be implemented by the state. And the faster evolution of technology, especially digital technology. So those are the two that are two mega trends that we need to take into account to get to where we need to
Gil,
be.
will this have implications to budgeting going forward? Because at what point do you want to start executing on this new revised?
Not in the short term. The budget that we have put forth, you approved back in December, is still going to be valid for this year. But we will take into account, coincidentally, our budgeting process starts in July. So for 2018, we will take into account whatever relevant changes we have made to our strategic plan.
In conjunction with this digitation, are you digitizing, whatever the
Easy
term-
for you to say. Right.
Are you as comfortable with our cybersecurity measures to go hand
Yeah.
in glove with this?
Absolutely, Judge. There's really no digital strategy if we don't start with cybersecurity. So Ken had mentioned in one of our solicitations, it's going to be focused on cyber. Cyber has to be pervasive when we implement our digitization, and it's not a static issue. It's a very dynamic issue, and we are focused on it. It's an industry focus as well. But I want to assure the board that we are taking all the necessary steps and all the hard thinking, really, to make sure that that is a very high priority and a prerequisite to digitization.
And are you working into the digitization discussion, sort of the evolution around artificial intelligence and machine learning? Will that be worked into
Yes. So
the next phase?
yeah, absolutely. The era of machine learning, it's part of data analytics. And the beauty of this really is the marriage of our technical expertise. Our staff knows our equipment and how they operate. What we need to couple that with our expertise in machine learning, expertise in statistics, expertise in math and modeling, and data visualization, so graphics. So the combination of that set of skill set with our technical and operational knowledge is what's the secret sauce to be
that will be built into
successful.
what you
That
can
will be
buy.
built in, absolutely.
I mean, I know we're somewhat time sensitive, but let's build some more time into July so we can talk about how, the organizational evolution here to maintain your strategic focus, be nimble in response and all the rest of that while you're moving, in tandem operationally, all the rest. We can talk a little bit more then in July about
Yep.
all this. Okay,
Yep.
great.
I think that's
Okay.
that's all I have.
All right. Super.
Thank you.
All right. Thanks, Gil. Subhagya, a remote via video. You can stay seated it's up to you. You're up. I can only see the lower half.
Yeah, we can't see
Or
you.
you at all.
Oh, there we go. Okay.
Gotcha.
All right, so Bhaga, you're in focus.
Thank you, Mr. Chairman and trustees, and good morning, Mr. Chairman, trustees, NYPA executive team, and all the colleagues watching this telecast. So, as you will notice that in your content pack, we have the regular CRO report, but the presentation today will be on the governance around our commodity risk management or hedging program. This is basically, Mr. Chairman, we're responding to your ask a couple meetings back about the governance of the process that we are putting together. So, just a quick rehash. What we're trying to do is to, contain the variability of the merchant portfolio gross margin, which is significant, which has got a significant impact on our net income. But we're trying to do that without sacrificing the ability to take advantage of the market opportunities, meaning that we don't want to leave money on the table while ensuring that we protect our bottom line. So what we're trying to do, next slide, please. So what we're trying to do is we're trying to implement a process by which we protect our gross margin to cover our fixed charge coverage ratio, twice of that. So the target is to cover the gross margin limit at 1.75 times of the gross margin of the fixed charge coverage ratio. But we'll start reacting if the gross margin hits twice the FCCR limit. And then, we have a stop loss limit at 1.5 times the FCCR. So, basically at that point, we will just close all the trades and, we'll just curtail the loss at that limit. So that's our protection mechanism. How we accomplish this, as you can see in the slide, that we have regular meetings between risk management and our energy resource management teams. Energy resource management team under Jill, they meet every day in the morning. And then we do, between ERM and risk management, we do a portfolio review weekly. And we also have twice a month meeting with ERM to review the sort of action items, specifically. And then last but not the least, we have the Executive Risk Management Committee. As you may recall, we had the charter revised end of last year. So we have a monthly meeting of the ERMC. So anytime a gross margin target is changed or limits any actions taken, the ERMC approves. In addition to this process, we have volume limits for traders. So they cannot exceed certain volume limits without approval from their next level officer. We have that in the appendix. I'm not going to go through all the details in the interest of time. And then we also have trading term limits that is also based on the trader's level in the organization. So those are kind of the governance process we have we put together. Next slide, please. So we monitor risk management. We monitor the performance of the merchant portfolio on a daily basis. So as you can see, so the first pie chart shows our counterparty distribution in terms of their credit rating. So we deal with very highly rated counterparties. But we do have, a significant amount of transactions in the exchange traded market. So we're trying to, manage that by managing the collateral requirement. So on this slide, on the graph on the left side, left or right, the bar chart, you can see that currently our collateral posting is about $1 million. S&P advises that we need to be protected against a certain percent, 40% price movement. So that's 54. Our target is $70 million. We can observe a collateral requirement up to $70 million, which will need at this price a 54% price movement, a negative price movement for us to hit that collateral limit. And the last slide is the last graph in that slide is the counterparty by industry. So that just gives you a flavor as to how we are ensuring discipline and governance around our commodity risk management, commodity hedging program. So I'll end there unless there's any questions.
Yeah, I just had a question. The counterparties, they're who we've been transacting with all along, right? These are not new counterparties. Is that right?
I'm sorry.
Yeah, we've had long relationships with a lot of them.
Well, and just to broaden that question, is this your recapping for us long-standing processes and procedures? Are these newly instituted? Give us some context there. Subhagya, Jill.
Yeah, well, let's.
Bob.
So yes, Mr. Chairman, there are some of the processes, the RMC and all these, processes were long-standing. What changed is basically that we have made the hedging program a multi-year hedging program because we think that we can be more proactive. And I was talking about our ability to, hit gross margin targets will improve with multi-year hedging programs. But also, we've just recently revised our traders volume limits and term limits, and we are, as risk management, we're getting more involved with ERM to manage that process more proactively. So there are, some of the processes were long-standing, but we have made some significant improvements with that.
I should also add that in addition to the governance, which has been long-standing but improved, we're, I believe, much more disciplined about our trading strategy to make sure that it aligns with our financial targets. So on the overall theme of more disciplined financial management, the hedging program now is much more analytically designed to achieve the budget and the financial targets that we have. And we are expanding the program, as Subhagya indicated, to multi-years so that we have better longer-term visibility into our financial forecast.
What's the maximum number of years we go out? What's our?
Right now, our plan is to go out 3, but right now we are fully hedged for 2017, and we're making transactions in 18, looking to layer in 19, 20. Yeah.
Okay, got it.
You reference S&P here. I'm just curious, rating agencies look at what we're doing. Do we get credit for what we're doing? Does it give them pause? Are they, I don't know if complimentary is the right term, but are they supportive as opposed to the woe factor here?
No, they're definitely supportive of what we're doing, and they have certain parameters, as I'm sure you're aware, regarding credit criteria, collateral criteria, and we tie ourselves very closely to those parameters.
So we're not pushing those boundaries, or
no, and we have our Treasury staff is the one responsible for setting and maintaining the credit limits and the collateral requirements. So we have the proper separation of duties. And we give the rating agencies total visibility into all of that.
Okay, great. Terrific.
So we actually, Mr. Chairman, we actually do more than what the credit rating agencies expect out of us.
Great. All right, super. Any other questions for Subhagya? All right, great. Thanks very much, Subhagya. Appreciate that.
Thank you.
All right, shift to the operating team, if you will. Joe, Jill, and Bob.
Thank you, Chairman, trustees, Gil, and staff. Go to the next slide, please. Or do I got it?
It's now afternoon, so if you say good afternoon, good morning, we've crossed the threshold. So.
Good news is utility operations is all green. We are very happy to report that generation market readiness is green. Unit 2 is back in Niagara. We have our full fleet back available there under routine maintenance. Transmission reliability, there were no surprises, and all of our planned maintenance is going well. The one incident we had in environmental is a suspended solids. It was right here in St. Lawrence, just a thing that we have from runoff from rain. And DART rate did go up a little bit. We had two incidents that were recorded under the DART rate, one in 500 megawatt and one at BG, but generally everything's trending very well. And a credit to your home team here, Judge Nicandri, Ed Ryder, his staff here have been the front runners on most of our safety initiatives with Calvin Smith and local IBEW 2032. Next, please. Canal transfer, really not much else to add there other than everything is on track in terms of the budget. The staffing is underway right now, especially for the summer season. We have to get a number of people into place because that's their peak season for a lot of their maintenance activities, and they use seasonals for that. And the good news is even in real time, our transitional service agreements that we plan to exit, we're actually up to 18 in real time. Of the 41 have been exited, and all others are on track as they trend today. So in general, everything is on track in utility operations, and we're good, and I'm open to any questions.
So one item I had circled, Joe, was your TSAs, or transitional service agreements. So in terms of how those expire or how those run off, if you will, how long are we carrying? Are there any surprises in the remaining, you said 18, so 23? I mean, all that's ticking and tracking okay, and we're otherwise stepping in, and we're otherwise stepping up and hiring, and
I would argue
moving okay there? Are we having any concern with the 23 that are still hanging?
No, I don't think so. I think most of them are on, and Kim can add some to this as well, but most of them are on the longs of the ongoing construction and project management type projects that we're doing. So those are going to come to conclusion throughout this year, and we'll be on track with some of those, most of those.
So the organizational build-outs on pace, and
yeah,
cheeks in the seats and boxes and all the rest of that, we're feeling good about how that team's coming together?
Yes, we continue to push for filling FTEs. Seasonal hires are up. That's the biggest challenge we have. It's our first year of ramping up. There's a number of employees we have to bring on for that. With respect to the TSA specifically, some of them we're actually exiting earlier than anticipated, so we are pushing for an exit so we can be masters of our own destiny, so to speak.
Right.
Others we're looking at converting to one specifically a long-term agreement where it's it's cost inefficient for us to do it.
Okay.
It's like a emergency dispatch thing. So we're still working the TSAs, but quick exit, extension where we need it because it's cost effective, and any kind of tweaks we need because services, we're getting into it now and we're seeing what additional services we need. In the short term, all of it.
Any ramifications from the delayed opening? I mean, that was...
Actually, it supported a lot of our activities to have the delayed opening.
Okay, and there's no market response, no...
The delayed opening, the community relations team and both Brian and John Callahan did a great job of doing the stakeholder management of all of the groups that we had to engage in.
Great.
Generally positive feedback, and we just pushed that this is for the betterment of them, because once we open, we want to stay open. So that means we're going to get our maintenance work done.
Okay, great. Ed told me this morning on the ride in the Seaways, just reopening or whatever, so we're right in line.
Right,
so,
exactly.
All right, super. Any other questions for Joe? Oh, Jill's up.
Jill's up, buddy. All right.
Questions. Joe, you're down. Jill's up.
Quick handoff.
Let's roll.
Good afternoon, trustees, NYPA colleagues. This is a commercial operations report. You have the next slide. So summarized into one slide for everyone today. What Bob will talk about a little bit on how this impacts the financials, but starting on the left-hand side, on the customer side of the business, we're doing well in our first quarter. Our number of the collection of fees that we're making on our project up, we're a little ahead of budget. We're about $500,000 ahead of budget. And on the operating costs for the customer side of the business, we're a little bit below budget, $900,000 below budget. That's driven by some of our vacancies that we haven't filled. We're looking to try to be a little bit of a leaner team, and we're managing the organization. On the right-hand side is some highlights from the wholesale side of the business. Electric prices are down from our budget quite substantially, as you can see, about 30% down. That's, as usual, largely driven by fuel prices. This is the end of the winter season, the heating season. Even with what we were seeing as a lower forecast year over year, we weren't low enough. To see fuel prices through the winter around $4, it's very low, and that led to the low energy prices. But as Bob will talk about, we did see some offset because it's been a very wet time of year, and so we have higher than expected flows through the plants. So at a lower price, but we're selling more megawatt hours, so overall it was a net out for NYPA.
The rate volume play is working to our advantage.
Yeah. Yep. It's my high-level summary of where we are with commercial ops.
Thank you. Thanks.
Any questions for Jill? Okay. Thank you for the flyover. Bob, our financial trends seem favorable at this early stage. We look forward to your embellishment thereon.
Okay, thank you. Good afternoon, all assembled, trustee colleagues, members of the public. So yes, we do have a positive result for the first quarter to talk about. The budget for our net income year-to-date through March was $22 million. We've seen a total net income of about $62 million, largely driven by 4 factors. 3 of those are largely outside of the boundaries of our operating plan, unexpected events that were largely outside of our control. I'll delineate those for you. The first line item, as Jill mentioned, has to do with energy prices and margin. As Jill said, prices were down. We budget conservatively on prices, so we budgeted at something below what the prices were at the time the budget was put together. That conservative forecast has been borne out, and so prices are lower than what they were at the time we put the budget together. But fortunately, as Jill said, we offset that by the fact that there was greater than budgeted flows in volumes of water through our hydro plants. We budget for that conservatively as well, so that we budget about 5% below our forecast in order to allow for some underrun in the amount of electricity that comes through our hydro plants. We've seen in the past 2 years that we've actually underrun our volume forecast significantly, so we've budgeted conservatively going forward. This year, we've actually seen a wet winter, and the amount of water flowing out of the Great Lakes and through the rivers into our plants is right on our forecast. But again, because we budget conservatively, we're seeing some positive variance through the first quarter. Remains to be seen whether that continues for the rest of the year. We have reason to believe that there might be some positive variance going forward.
Just to clarify that, Bob, so it's a rate volume, so volumes working to our benefit, rates working against us.
Right.
We expect rates to stay down. I mean, as you said, Jill said, they're significantly lower than we're budgeted. So we have some exposure there, in that rates presumably will stay low and water volumes a little less predictable.
So we do 2 things to try to manage the rate risk. One is we have our hedging program that Subhagya talked about.
Right.
So that moderates a lot of that effect. And then we also budget conservatively to account for potential risk on the downside. So we may be slightly below our budget on the rate side, but it's been more than offset so far to date by the volume that has gone through the facilities.
Okay.
The next line item relating to transmission, this is due to the HTP transmission line outage. We pay a capacity payment to the owners of that line for the service provided for that line, and when it is out, we don't have to make that capacity payment. So we've seen a positive variance in our financials over the first quarter. That was obviously an unexpected event that we believe is going to continue for some time through the latter part of the year. So this was not in our operating plan. It's not part of our operating plan, but will be likely result in some positive variance going forward.
And this outage, just so we're clear, because it wasn't in our operating plan, was the outage ended up lasting longer than we had expected.
Right.
Based on our discussion at the last board meeting.
That's right. So when we approved the budget in December, we thought that the line was likely to be fixed in fairly short order. It turns out that we're talking about a much bigger project than we thought, and the outage is likely to last till towards the end of the year.
But that doesn't create, refresh our memory as to, does that put us at risk from an operating standpoint, power generation, power access, availability?
I'll turn to Jill for that.
We don't see any impact to reliability even coming into the summer.
Right. So not doesn't put us in harm's way, the fact that we don't have the availability of the line.
Yeah.
So net, this is good news all the way around.
Yep.
Okay, great.
Let me skip the third item. I'll come back to that. The fourth item is a one-time item of $8 million that related to the transaction to transfer the Nuclear Decommissioning Trust Fund to Entergy as a result of the sale of the Fitzpatrick Power Plant. This payment represented essentially the settlement of various rights and obligations under the contract governing the Nuclear Decommissioning Trust Fund, and is a one-time transaction-related event. So we won't see that recurring. The operating expense line item is largely an underrun of our O&M budget. That this largely occurs. We see this occurring every year. This is actually a little bit smaller than we've seen sometimes, but it relates to the fact that we typically don't do as good a job as we should of budgeting monthly expenses versus budgeting the annual expenses. So it's a timing issue that we expect may, to a large degree, reverse itself by the end of the year. So we have just 1 quarter of data on this at this point. We need to do a better job of doing our monthly budgeting, but we do expect that we are on plan, relatively speaking, for our total 2017 operating forecast relating to our O&M budget. Any questions on that or any of the other items before we move on?
Anything at all as you look ahead? I know it's a little bit early to be reforecasting, but while there's obviously been some very favorable events to our benefit, anything that at this point gives you pause or concern as you look ahead?
No, I think our
plan's pretty comprehensive.
We've done I think our usual very good job in managing our core operations forecast and operating budget. The canals is obviously a new enterprise for us, so theoretically there's some uncertainty associated anytime something is new. We'll see what happens there, but as you know, when we presented to the board, we went through a very detailed exercise of budgeting for that. But we'll see whether there's new information that comes during the year.
Okay.
Moving to the next slide. Whoops. The total net income versus budget is shown on the left side of this chart. I've explained the variances associated with that. Compared to last year had some double counting, as you recall, in the first quarter due to a payment that we made to the state budget in the beginning part of the year, and then we had canal expenses in the latter part of the year. So there were some timing and double counting issues that make it difficult to compare versus last year. But again, versus budget, we're doing well this year. In terms of the economic value added calculation, remember that our target for EVA is 0 at the end of the year. So our budget for 2017 was to make our target. If we look at where we are versus that budget target, we're at about where we are through the first quarter of about $25 million of economic value added, and that largely relates to the same variances that I just described. The ones that are kind of included in this calculation are the extra water volume that results in larger electric generation, and also the underrun on the O&M budget. The other two items are kind of below the line for the purposes of this calculation. And you can see the results on the right side. Without HTP, the numbers are a little bit better, both in the kind of the before and after the budget number as well as the actual number. So
a little too early to extrapolate all that forward. You'll have something more for us next time we're together.
That's right. And again, because of the one-time item on the EVA calculation won't be affected by the one-time item, but we'll see how the water flows work out. Well, next time we meet, we'll have a clearer forecast for you at that point.
Okay. Any questions for Bob?
No, I don't.
All right, thanks, Bob.
Thank you.
Keith, you're batting cleanup today. Our annual compliance review, Recharge New York. Are we in compliance?
We are.
Okay.
Good afternoon, Mr. Chairman, trustees, and everybody in attendance today. This item is in regards to the Recharge New York Power Program's annual compliance review. Authority staff has conducted its annual compliance review of customers receiving Recharge New York Power, covering the reporting period of July 2015 through June 2016. Per the contract, these customers began submitting their compliance reports to the authority in August of 2016. The compliance review examined customers' compliance in 3 areas, those being job retention, capital investment, and power utilization. Staff conducted a review of background information on these companies as well as an analysis of commitment levels reported. Staff is recommending enforcement of the contract commitments for specific customers who have failed to achieve at least a 90% compliance level for job retention commitments, capital investment commitments, and power utilization. This is in accordance with the contract. This item requests that the trustees approve the reduction of allocations and/or the modification of supplemental commitment levels for 68 companies receiving Recharge New York Power. To give you a little background information, some of the key findings from these analyses include that the breakdown of noncompliance of the 68 customers is as follows. 67 companies were found to be below 90% compliance with respect to jobs. 1 company did not meet the 90% compliance threshold with respect to power utilization. In addition, 15 companies are being recommended for a take-no-action decision based on extenuating circumstances. The trustees have been provided with information on each company as well as a summary of the business case for your review. This item is submitted for your approval. I'd be happy to take any questions.
This topic's been a source of discussion in the past. It's a little tricky one to navigate, help us with any tricky, my words, not yours, or my word, not yours, aspects of this time around. I mean, it's our job to stimulate, it's our job to support, it's not our job to punish and withhold. So striking that balance.
Yes, and actually we reached out to every company that we're taking compliance action against, and we're essentially right-sizing them. We have received no negative feedback from those companies. So this is as expected. It's an annual process, right. So these companies are used to it. One thing I'd like to point out is the total commitment of jobs under the Recharge New York program is 337,809 jobs. Even though
minus 337,908
just round figures.
Okay.
Even though we have some businesses that are not in compliance with their job commitments, the total jobs reported under the program this year are 337,665. So we're short a little over 100 jobs in total.
I'm a round number guy. I round that to 338,000 either.
We're right on.
Okay, good.
So one question that
I was just going to say, first of all, thank you for this booklet.
You're welcome.
I know you prepared this for this date, but I hope everyone knows it's a comprehensive list of all of these programs. But I was really impressed by the capital investment that a lot of these businesses are making, and so there's a multiplier effect
no question.
that isn't even captured by the number of jobs that are created. And so I think that's significant to at least put on the table, because some of them well outspent what they initially committed in terms of capital. And
over $70 million.
Yeah,
yes.
that was quite remarkable.
Yeah, that was impressive.
That's a great point. Thank you.
So one question that I had was when you talked about the ones that we didn't make a decision on because of extenuating circumstances, can you give me a general idea of what those kinds of extenuating circumstances?
Absolutely. For instance, when we complete the compliance activity in the period, it's for those dates that I mentioned. But beyond that, up to the current date, we have companies that are hiring as we speak. So when we see them trending in the right direction and they're hiring back those jobs, we take no action.
Okay, thanks.
At one point, we were below the 90% compliance rate. We eliminated that pretty much?
Yes.
Okay, so this is back up
to 90.
Standard.
Yeah, we dropped down to 75, I recollect.
That was in reaction to the recession.
Yes.
Right.
Yes, exactly. Back on track, Judge.
Okay. Any other questions for Keith? If not, I'd ask for a motion to approve the resolution as presented.
So moved.
Second.
I have a motion and a second. Unless there's any other questions, all in favor, aye?
Aye.
Aye.
Any opposed? Motion carried. Keith, thanks very much. Good work.
Thank you.
Great report. Nice outcomes. Well done, one and all. All right, with that, unless there's any other matters to come before the board, I'm pleased to close the meeting. Our next session, as has been referenced a couple times already, will be tail end of July. I think July 25th is the specific date. Back at the White Plains office. Won't be as scenic and enjoyable as it is here in Messina. It's another road trip, another away game for you, Judge, but such is life. But July 25th, we'll all be back together then. Gil, looks like you want to tell me something? No? Okay. Otherwise, I'd ask for a motion to adjourn.
Second.
All right. Anything else? All in favor? Aye. Motion carried. Aye. Motion adjourned. Thanks very much, everyone. We were looking forward to a fun and exciting and proud afternoon. Thanks for joining us today.